Okay, Okay, last time we stopped around here. Uh, for this chapter, yeah, the content of this chapter is actually quite rich. So we cannot finish everything today, unfortunately. So we'll leave some part to after the holiday. So well, I guess it's not necessary for us to emphasize the importance of uh, risk-free rate reference again, right? It is important everywhere. So we talk about uh, treasury rate, overnight bank borrowing and lending rate, and as well as the repo rate. So the last one we want to talk is actually the LIBOR. So LIBOR actually have a very long history, but unfortunately nowadays we abort it. Okay, we never use it anymore. So just several years ago, not even when I was an undergraduate, but even if after I get into the master program, I think it's about 2026, sorry, 2016, sorry, 2016. So just several years ago, so LIBOR was still the golden standard. So when I took the derivative class, so all the examples in class examples start with okay if the 3 months LIBOR rate is what, so somehow like that. Um, so there are some reasons. There are some reasons for LIBOR to be popular at the beginning. So LIBOR used to be very convenient to use because LIBOR was announced within the London Exchange every day at the 0 a.m. So basically the end of the day and the start of the next day. So and then all the very high rated banks, they kind of submit a table like every day by the night. So that table looks like this. Okay, I don't really know the exact table. Okay, but the one looks like this. So the table will include different currencies. So on, and then different maturities. So for a specific currency and a specific maturity, uh, the bank will report interest rate they would like to offer or receive. Okay, so each bank will submit such a table. Okay, several currencies, several maturities, they'll submit a table about their influence on the risk-free rate. And actually 20 or 30 banks in LIBOR, sorry, in the London Exchange, they will almost at the same time submit the table every day. And the exchange will have some mechanism like exclude the lowest, exclude the highest, and then compute the average of all the remaining. So then the exchange will report the interest rate uh, almost everywhere. Everywhere they can report the interest rate too. Okay, so you can actually sense the convenience of a LIBOR rate very well because it is so convenient, right? It is a consensus among all banks. It's like an auction, right? People try to bet on the interest rate together. So it's like an auction, and it consists many banks' different opinions and. It is reported very timely every day. You have the very daily report, and it's undoubtedly that it's such a very convenient benchmark can be used very well in transactions. Okay, but the problem is that later uh, we found some manipulation problem. okay, associated with LIBOR. So especially during the financial crisis, actually those banks manipulate LIBOR for their own purpose. Okay, so we leave the question there. So later let our classmates to explain it. So the consequence is very severe. Such a golden standard, LIBOR got phased out by 2021. Okay, and by the way, nowadays for your age, maybe once we mention some years like 2020, 2021, you may thinking about that this is somehow related to the COVID-19 or something. Okay, but this is not the case, at least for LIBOR. So LIBOR's phase out and was initialized very early, 2015 or even earlier, somehow like that. So the procedure is gradually applied. So until 2021, right? All the financial institutions, everything in the market, they get rid of LIBOR forever. They tend to use their own reference rate, and so they all usually, LIBOR is so convenient. It reports different time lengths. So for the new reference rate, it's very hard for you to really find good environment to have the risk-free rate, unless you have short enough time lengths. So what they did is that they try to compound overnight rates for a certain period, like for one night, maybe that the interest rate is what, but they try to compound it, okay, so that they can produce some like 3 months risk-free rate something. Okay. So there are many new reference rates now in different regions, different exchanges. In the US, it's called SOFR, Secured Overnight Funding Rate. And in the UK, it's called SONIA. In the EU, it's called ESA. Well, I don't know why they try to use some human names in the reference rate. Maybe that's more sounding. So we just take SOFR as one example. Okay, this is not because we are using a US textbook, but rather we're just trying to draw one example. Okay, other reference rates are almost the same, just they rise in different area. So SOFR is actually a repo rate, although it is called overnight funding rate, so it may let you recall something like Fed fund rate, and that's not the case. It's not the case. SOFR is actually a repo rate. So one significant difference between the repo rate and the overnight or the lending rate is that repurchase, the procedure here itself, if you think about repurchase alone, repurchase is actually a secured transaction. Okay, that means this is not really a permanent transaction, but rather a temporary borrowing and lending. And so if you're thinking about repurchase as a borrowing and lending procedure, you can see that the bank or the large institution who hold those securities, who temporarily sell the security to the repo market, they actually lend out, they actually borrow money from the buyer, okay, and they use the security, they use, for example, treasury bond, they use the security as their collateral. And if I don't repurchase those security at the contracted date, you can take the security out, right? And the same thing applies to the buyer of those securities. Okay, they deposit the money into their margin accounts, they get the security. So this is like they buy, they try to temporarily hold the security for a while. And they also put enough deposit to make sure that they will default. So repo rate or the repurchase market, the One basic feature is that they are actually a secure market. You always have collaterals or transactions. So this make those repo rate the most risk-free rate among all reference rate. Okay, although our like treasury, like all rates, they are good references, but repo rate here, considering about the secure nature, it is the best we can have. This is the foundation of SOFR. Okay. So another problem related to treasury is that the although the treasury later will also use the treasury to try to derive the risk-free rate, but in practice, the treasury rate is sometimes too low for risk-free rate. This is the first glance counterintuitive, right? Because it's hard to thinking about that any financial assets can have even lower return rate than the risk-free rate. Like risk-free is like our baseline, our bottom line, and there is any one asset is even lower than it. This is sometimes counterintuitive. So the practice is that treasury bonds are exactly traded with a premium so that their interest rate is actually much, not really much, but a little bit lower than the true risk-free rate. But we call this phenomenon, we call it treasury richness. But this richness actually varies across times, across different market conditions. So it's not really that large. That's one thing. And we can also explain it in some way. So there are actually many reasons, okay, many different for different institutional investors, they can utilize treasury bonds for different purposes. So we only list two here. Okay, definitely there are more than that. Okay. So the two reasons here is that the first, the capital requirement for treasury is low. Almost nothing. Okay, treasury used to be treated as cash equivalent, totally equivalent. Okay, so this is totally different from others. Okay, I don't know if you're familiar with the history of financial regulations. Okay, so the history is like comes to 21st century. We have the Basel II regulation, so it covers almost all existing financial products. But then it comes to the financial crisis, 2007, 2008, and people find that, okay, actually the regulation on derivatives are too low. So just immediately after the financial crisis, there is a Basel 2.5. Okay, it's like a temporary patch. Okay, try to update some regulation on derivatives specifically, and then several years later, I think it's about 2014 or something, around then. Okay, the Basel III comes out. So right now we run with Basel III regulation. So let's take one example. You can see that the capital requirement. Okay, so for banks, okay, in addition to those, in addition to margin accounts, okay, you sometimes you need to post some more capitals to make sure that you won't default. Okay, so for example, like in Basel II, the requirement for a general derivative is that usually you need to, if this derivative was for 100 US dollar, you need to maybe deposit 30 or 50 US dollar, so that if there is any future transaction associated with this derivative, you can have you have enough cash to manage your position. Okay, then come to Basel III, the situation turns more severe. Come to Basel III, usually for options, for futures, they require the bank to deposit at least 100%. Okay, so like if this derivative was 100 US dollar, you just deposit another 100 US dollar to make sure that no matter how the price of this derivative change, increase or decrease, you will have the full capacity to react to any situations. Okay, so you can see that the different assets got different treatment. Okay, if the assets is much riskier for banks, the regulation is much more strict. Okay, but for treasury, they are treated just like a cash. Okay? And so this part is quite a magical part. You can think about that. Treasury bond is by the end not really the cash. Okay, but they are traded, they are used just like cash. Okay, this actually enlarged the bank's capacity, the bank's pseudo cash to a very high level. So the bank can do much more than they can do with their existing cash balance, right? So this is one reason, existing like explaining why the demand to treasury bond is so high that actually making the bank's return the bonds return rates too low. Again, also the tax treatment. Okay, so you know that treasury instrument usually they are free for federal tax, right? So maybe you are familiar with the U.S. federal tax, maybe you are not, but across different countries, the progressive income tax brackets are quite common across different countries, right? In the US, actually, the tax rate is not very high, I would say. If you go to Sweden, as long as your income is higher than a certain level, your tax rate is 80%. Right? That means if you earn $5, you need to pay the tax $4 to the government in Sweden. Right? So that was insane. And so for the US case, right, if you are rich enough, you have the super billionaire tax bracket. For those earn more than $1 million per year, your tax rate about 1 million threshold is 50%. Okay, so that means for any $2 you earn, you need to pay $1 to the government, right? So in that case, even if the treasury bond can offer you a relatively lower interest rate comparing to a corporate bond, but if you're thinking about that, if you are a billionaire, you have a treasury bond offer you 2% interest rate, the other one, corporate bond offer you 4%. Looks like from the numbers that the corporate bond is much worthy, but after tax, after 50% super billionaire tax, the interest payment to you for from these two bonds are actually the same. And then, in addition to that, the corporate bond is much more riskier, right? It has default risk, but the treasury bond usually it don't. It doesn't have any default risk, right? So this is about risk-free rate. The Y treasury rate is not really useful for reference rate, but this does not mean treasury rate is not useful at all. Okay, actually, by considering about the treasury richness, okay, by try to make some adjustment, you can somehow make some risk-free bond from treasury bond, right? Like for example, you can just add 99% treasury bond, 1% municipal bond, right? Virtually they are still a risk-free case, and by just adjust the portion of different government bonds, you can have a synthetic risk-free bond you can build with it. Okay. So compounding, I don't really want to spend too much time here. This one you should learn it again and again in corporate finance, right? Just one thing I want to mention here is the conversion of interest rates in different compounding frequency. You can easily done it in this way. Okay, for example, if this is annual case, this is T. You can convert it to quarterly basis. I add 4 here, add 4 here. So this is a quarterly. Right. If you change it to higher frequency, right? You just change the corresponding numbers inside the bracket. And if you extend it to the limitation to seek the continuous compounding, you have the E R. Okay, let's note RC. Okay, C for compounding, ERC here. Okay, so just take the natural logarithm of this formula. You will get the conversion formulas here. So if you take a natural logarithm, okay, you can first take out t, okay, because this is common for all specifications. So RC, if you take a natural logarithm, this is only RC. This side, you have like a 4 ln 1 plus 4 over Rm, right? This is exactly the formula there, okay? So this part, I guess, you know it a lot very well, okay? So next point, zero rate. It's still not really the content of this course, but as a good foundation, okay, I will tell it. I will talk about the story here again. Although I guess you have learned the story already from other courses. So here, the purpose of zero rate curve is that you have a bunch of zero rate for different maturities so that you can utilize the zero rate for your discounting purpose. Right. And by the way, usually the zero rate we construct is the risk-free rate curve. But definitely, it does not mean that the risk-free rate curve cannot be used for a risky asset, right? Because always, right, you can find the relationship between the risk-free rate and the risky assets return using the CAPM model, right? Like if you are about to evaluate the company's value, company's stock price, so you can use like a dividend discount model. Okay, right. Here is discount rate, right? For different times, you should have different discount rate, right? And even if you know the corporate's discount rate should be a risky rate, it should be higher than risk-free rate, but still, this can be done by combining the RF plus some beta exposure to the market risk. Right? Using the CAPM model, you can have the R here. So all this is very beneficial, very beneficial. Here, our discounting, we would like to construct a zero curve. Time response. Mm-hmm. Okay. So technical problem happens all the day. I don't know why. So for zero rate here, okay, we call it a zero rate because usually we require there's zero temporal payments throughout the lifetime of this investment. So for the zero rate calculation, if take one example, okay, if you can find a risk-free bond in the market, and very luckily this risk-free bond is a zero coupon bond, then this can be used for our zero rate construction very easily. But for example, if you have like a 10-year treasury bond, you want to use it for zero rate computing. So despite the richness, which making the treasury bond interest rate too low, still the treasury bond itself does not qualify as the component of a zero rate because the zero rate here we require that to calculate the interest rate earned from an investment that only have a payoff at the maturity. Okay, so for the treasury bond, usually the payoff coupon payoff is semi-annually. So every half a year, this treasury will give you a coupon, half of the year. So with several rounds until the maturity, they'll pay you the principal and coupon. Right. So in that case, this treasury bond will have some intertemporal payouts. So it does not qualify as an asset in zero rate. But this does not mean we cannot calculate zero rates from this bond. We need to have some method, right? The bootstrapping method, we'll talk about it later. And still, right, bond pricing, I guess some accounting courses talk about this already. So I just briefly touch it. Okay. Although you should not forget any of the parts. So I just want you to get familiar with it. Typically for bond pricing, given the zero rate curve, given the proper discounting rate for any specific time period, you can use the zero rate to discount all the future cash flows so that you can get a fair price here. So in this example, if this bond have a coupon rate of 6% and it's a semi-annual payment, that means for each half of the year, they pay out 3%. Okay, so just take the 100 as the par value of the bond. It's more like an example. So then for the bond with a par value equals to 100, at each half of the year, at each coupon payment date, you got $3. You got $3, then $3 here. This one is a 2-year bond. So by the end, you got $103. Right? This is a typical future cash flow structure for a bond. So to get its proper present value, we need to discount each future cash flow with a proper discount rate. So we can use the zero rate into it. Okay, don't forget the time. Okay, by the end, you get a PV equals to 98.39. So this is right. Very conventional NPV method. You shouldn't be you shouldn't have any difficulty on it, right? So in addition to that, if we take the price as given, or if we set a certain price to the bond, we can measure the bond return rate with two yield measure. So one is called bond yield, the other one is called par yield. So bond yield is like this. So instead of calculate the fair PV based on a certain zero curve, so we give up a zero curve first, and take the market price of the bond as given, as the correct price as given. Then we further assume that across all different time periods, the discount rates are the same. Okay, in that way, the previous formula now have the PV already there, 98.39, added there as the correct price. And then you wipe out all the zero rate inside the power term and replace them with a single Y. So this is the one for all discount rate for all time period. Okay, this one still a formula with one single unknown number. Your slope for the Y. This Y is a so-called bond yield. So this you can explain the bond yield in this way. Okay, assuming that there is no difference in discounting rate across time, the bond will bring you a return rate approximately 6.76. Okay, so this is like measuring the return rate. Okay, this is more like somehow similar to the expected return of a stock, like that. Okay, so bond yield is a measure for the return rate. So another way is the par yield, right? The par yield here, it runs in a quite strange way. So par yield here is like you take 100, you take the par value of the bond as given, and also take the discount rates, take all the zero rates as given. Then you hypothetically assume the coupon rate are unknown. Okay, so in this way, you have the discounting factor, you have the current price. The only thing remains unknown is the coupon rate in the future cash flow. So you can solve for the coupon rate. This coupon rate is called the par yield. Okay, so although bond yield and par yield, they are both called yield, but one is the discount rate, the other one is actually the coupon rate. Okay. The par yield is also another way to describe the bond's nature. And you can thinking about that the bond yield is like if the current bond price is very low, then the bond yield should be very high, right? That the return rate and the current price should have a negative relationship. Okay, instead the par yield here, okay, you can compare it with the current coupon rate noted in the bond contract. Right. So in the bond contract, the coupon rate is 6%. But what you calculate in the par yield is 6.87. That means to make the bond's current price equal to the par value, the coupon rate should be higher to 6.87, so that the bond can be traded in the par value. Okay, that means what? Means now if you get a par yield larger, higher than the existing the true coupon rate, that means very likely, not very, that means confirmedly the bond is traded in a discount, right? So there are all different ways, different measures to describe the bond. Okay, so this is just a very, very brief, very, very simple foundation for us to talk about zero rates. So the way to determine the zero rate curve is the so-called bootstrapping method. I guess other class told you already, so let me replicate this a little bit. So for bootstrapping method, you usually start from very short time bonds, okay, because usually for it's 12 p.m., you're still sleepy. So usually for those short maturity bonds, they are zero coupon bonds. Okay, for example, if you check in the website, you search about treasury bills. Okay, the treasury bills are basically referring to those shorter than 1 year treasury bonds. So they are mostly zero coupon bonds. Okay, so in that case, that bond yield can be directly used as the zero rate, right? Because zero coupon bond, you don't have any coupon payment date. Okay, the only payment happens at the maturity. Okay, so for the first one, for the first line here, if you get the risk-free bond from the market was 99.6, and it will pay you the par value 100 three months later. Okay, you can make a very simple discounting by doing like this. R 3/12, 100, right? So you can solve for R 1.6 something, right? This is basically the procedure to calculate the bond yield. Just because this is a zero coupon bond, so your calculation turns to be very, very simple. Okay, so you can repeat this procedure to longer maturity bonds as long as it is a zero coupon bond. So you can extend the zero curve here. 3 months, 6 months, 1 year. Okay, 1.5 year. So the 3 months one here, 1.6, 6 months, about 1.8. Oh, sorry, 3 months is about, 6 months is about 2.0. Okay, and then until 1 year, your calculation will be 2.2. Okay, so you have here, you have here, you have here. I can draw the curve like this. Okay, so for shorter maturity, the calculation is quite simple. Just to see the bond yield, put the bond yield there. That's enough. Okay, so then if you move to the fourth line, you will see that okay, well the time now this bond risk-free bond is not a zero coupon bond anymore. It has 4% coupon. So this means that the bond yield for this bond is not qualified into zero rates, right? So here you will have the bootstrap method to figure out the interest rate at this point. Okay, so bootstrap means that you put your foot into your shoes. Okay, so if your shoes is in a proper size, you will feel comfortable, right? So here, the bootstrap method looks like this. Okay, we know that this 1.5-year treasury bond, basically risk-free bond, will have a semi-annual coupon payment. That means at the first coupon payment, they will pay $2. Here also $2. Here 102, right? Because the total coupon rate is 4%, right? Then for each half a year, they pay you $2, right? So the first payment happens within half a year, and you have the zero rate for half a year. The second one happens at the end of 1 year, and you have the discount rate for 1 year. So you can discount them using the proper interest rate here. Okay, don't forget the length of time. So negative 0.02 multiplied 0.5, then 2e negative 0.022 multiply 1. Okay, the only last one here, you have e negative r 1.5 equals to is the current price. Okay, because this interest rate you don't know it. You can only put it there, but at least you know the current market price of this risk-free bond. Okay, so still you're having an equation. This equation has only one unknown number. You can solve for this r. This r solve it out, you have 2.28. So you solve for this 1.5-year zero rate. Okay, so this is like how you we expand the zero rate curve from a shorter time to a longer time. Okay, with shorter time, usually you can find a lot of available zero coupon bond in the market, because usually within 1 year, the practice is that usually within 1 year we issue only zero coupon bond, but for a long time, right, the situation changed a little, right? So here to talk about this bootstrap method, we are trying to give you a sense that the function of the bond market here is that it does not only offer you the ability to trade on bonds, to trade on a specific asset, but also the bond market serve as your monitor for interest rate, right? If you don't use the risk-free bond, if you use something like corporate bonds, okay, with a certain corporate risk profile, you can compute a zero curve, a risky zero curve, right? That's something different, but you can definitely use it in other ways. Okay. Well, we have the zero rate curve. This is actually not the main part of our course, and the main part of our course is actually the forward rate. Okay, so here the forward rate, here the story is that like this. Okay, you know that we in the derivative market we tend to talk about transactions happens in the future, right? Future contracts, it indicates an obligation happens in the future, right? Options, it indicates some rights that you can have in the future to buy or sell the underlying asset. So now for interest rate, okay, we also want to take care of the future. So here, the purpose is that okay, we understand that if you are the orange juice producer, you are trying to long the orange future contract to fix your costs in the orange, right? Fix your costs in production. So this, okay, in other words, we can say that in this way, okay. You use derivatives because you want to hedge the price movement risk. Right, so the price movement, upward, downward, this is some kind of risk to you. Okay? Then, a follow-up question is that, okay, so then, do we also have risk associated with interest rates? Right, the answer is actually yes. Okay, taking a very, very real world, very natural real world example. Okay, so for example, right, just assume, you assume that now the risk-free rate or the not really risk-free, but your bank loan rate. Okay, if you go to borrow money from bank, the bank loan rate is 4%, and everyone is expecting that the bank interest rate will drop. 1 year later, maybe it will drop to 2%. So for me, the question here is that, okay, if you want to purchase a house, would you borrow from the bank now, or would you try to postpone your deal later? Try to borrow from the bank 1 year later. This decision is quite straightforward, right? So if everyone know that the interest rate will drop 1 year later, will drop from 4% to 2%, nobody will try to borrow from now, right? Because if you borrow now, the cost is too high, right? Every year you will need to pay the 4% interest rate to the bank, at least, right? But if you just endure for 1 more year, stay with your old house for 1 more year, postpone your transaction to 1 year later, you can use a much more favorable interest rate for your borrowing, right? For your mortgage loan, right? So this example, what I want to tell you from this example is that interest rate risk is also very important. Not only the price itself matters, but also the interest rate also matters, because in the market, also in our daily life, it's inevitable that we will get more or less into the borrowing and lending, the financial activities. And once we get into financial activities, the interest rate matters a lot to us. Okay, so if the interest rate matters, then we can have some similar way to manage interest rate, just like how we manage our price risk exposure to orange. Right. So here, this requires us to have some knowledge about a forward interest rate. Okay, we call this forward rates. So this forward rates can be implied from a term structure, here. Okay. So for example, let's modify this term structure to a much easier case. Okay. If we have a term structure, this is a 1 year, this is a 2 year. Okay, so the 1 year interest rate is 4%, 2 year zero rate is 5%. Okay, now a magical part I can tell you is with this very simple term structure, I can not only tell you that from now on to borrow a short-term loan or to borrow a long-term loan, what kind of cost you should bear with, but also I can tell you that if you would like to initialize a loan at a future time point, I can also tell you how much you should pay. Here, in this range, if you go to contract with a bank saying that, okay, I don't want to initialize any loan from now, but I would like to borrow from you 1 year later and repay the loan 2 years later, then this bank will definitely offer you an interest rate 6%. Okay, this is confirmed. Okay, there's no other choices as long as you have this term structure. Why? Okay, thinking about this in a simple way. Okay, so if this bank do not offer you 6, they offer you 7. They said, okay, since making a transaction for the future looks very complicated, so we'll charge you a relatively high interest rate. Okay, so in this way, if this is their indicated borrowing and lending rate at this certain time period, okay, well, in this example, we will try to simplify the example by setting borrowing and lending rate are the same. Okay, so in this case, you can have our classical game, have the arbitrage. Okay, I already tell you the result, right? I already tell you the fair interest rate here should be 6%. So they charge you, they say that if you want to borrow or lend in this range, you should charge or receive 7%. This is relatively higher than the fair value, right? So in that case, we can do it in this way. If the interest rate here is too high, okay, then we try to earn this very high interest rate, right? How to earn it? We try to lend. We try to lend out money for one year and lend out for 1 to 2 here. Okay, so here, like for the from first year end to second year end. Okay, this is much more clear. Okay. On the other hand, we do the arbitrage. So we have the opposite direction. We will borrow 2-year loan. Okay, let's run this game a little bit. Okay, so you borrow 2-year loan. So the zero rate is indicated here. That means if this game is running with $100, So you will borrow this 100 US dollar for 2 years. So with the current interest rate here, you can see how much you will pay. Okay, so if you borrow 100 now, you need to pay 100 E 0.05 multiplied 2, basically 0.1. Okay, this is your total loan payment 2 years later, right? If you borrow 100 now, you need to pay back the loan 2 years later, right? So then, on the other hand, you lend out. Okay, so this is how you run arbitrage, right? You lend out, you don't use your own money. You borrow from you borrow this 100, then you immediately lend it out. You don't leave any money in your hand. So you first lend it out for 1 year. Your 1 year interest rate is 4%. Right. So after 1 year, your outcome is 100 multiply E 0.041. Okay, basically 0.04. Okay. So 100 E 0.04. This is your total revenue after 1 year lending activity. Okay. So you do it consecutively. Okay, you don't stop. You don't stop because now you are playing an arbitrage in the money markets. So you don't stop. You lend out this amount for the subsequent 1 year loans because the bank agree that your borrowing and the lending rate here is 7%. So this term will be lent out for the 7% for 1 year. And after 1 year, again, at the second year end, you will get 100 E 0.04 multiply E 0.07. So in total, you have 100 E power of 0.11. Okay, so this is your total revenue at the second year end. This is your total liability you need to pay at the second year end. So offset each other, you still earn a little bit, right? This is larger than your liability, right? So this is a long short position as well, right? This is a much more favorable. This is a higher interest rate, so you tend to long it, right? Here you use the lending to represent a long position, and you use a borrow to actually represent a short position. Okay, so here you can see the story here is that once the zero curve is determined, the forward rate at a certain future time period, in a certain future time period, is also well determined. Only if here the interest rate is 6%, there is no arbitrage opportunity, the market is fair. Okay, put it in this way, okay? So for a 2 year loan, okay, if I'm the bank, I offer two guys, I offer two persons with a 2 year loan, okay? The first person, they pay me 5% per year. The second person, after 1 year, they pay me only 4%. Okay, to make sure I earn the same amount of money from both of them. Next year, I should charge more to this second person, right? Because the first person, they always pay me 5% every year. But this one, the second one, they pay me only 4% this year, right? They pay me less than expected. So next year, I need to charge more. I need to let that guy pay 6% so that the game is fair, so that eventually what I receive from these two persons are the same. Okay? So this is about forward rate. So just the viewing point are different. Okay, so here for forward rate, your viewing point is from a specific future time point to a specific future time point. Zero rate always your starting point is now. Okay, just it tends to different future time point later. Okay, long or short. Okay, so the formula to calculate is very simple. Okay, this is also the benefit for you to have the continuous compounding. Okay, if you don't use continuous compounding, this formula cannot be applied. Okay, only if you use continuous compounding, this very simple formula can be used. So in this case, you have a 5% 2-year minus 4% 1 year versus 2 minus 1. So 10 minus 4 divided by 1, you get 6, right? So very simple formula here. Well, so with this method, with forward rate calculation, so now, right, we first extend the zero rate curve from short term to long term using the bootstrap method, and then we can further expand it using the forward rate calculation, okay, to see for any 1 year in the future, like from the second year end to third year end, or from the fourth year end to the fifth year end. Okay, we can test any specific time interval that how much interest rate we should apply to that interval. Okay. So I think that's all for today. And Yang Xinqi, Wang Ruixin, right? Okay, it's a time to talk about these three questions. Do you have idea already? Huh? Yeah, you just answer in there. It's okay. You don't need to write. Okay. Speak it loud. Mm-hmm. Okay, roughly correct. Yeah. Go on. Second, try to summarize why treasury rates are too low. Okay, use your own words. Mm-hmm. 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 Okay. The last. Mm-hmm. Mm-hmm. Collateral. Mm-hmm. Right. Okay. So for the manipulation problem of LIBOR, if you are interested in, you can search about the news. Okay, there are many news about it. Okay, basically, right in the financial crisis, when the bank system is unstable, manipulation can actually make the bank better, but it's definitely worse for the overall financial system stability. Okay. So for the last question, basically, Fed fund rate, the effective Fed fund rate is the overnight bank borrowing and lending rate, interbank borrowing and lending rate. They relying on the bank's credit worthiness, so they are actually unsecured um, financing, unsecured financing. So comparing to repo rates, their risk is relatively higher, although quite small, but still comparing to a secured transaction, it has a relatively higher risk here. Okay, so last thing, let me check the attendance, so you can leave. 戴诗颖、董子博、黄静雅、江永顺、金伟阳、孔令文、李家俊、刘劲峰、刘轩宁、刘洋、孟思彤、彭碧伦、钱亦可、absent。诗涵、王若欣、王心怡、吴敬泽、吴自豪、向成轩、杨新奇、杨逸超、于成 absent。于静怡、于瑞思、张雨欣。OK，于静怡、于瑞思 also absent。OK，that's all for today. Thanks.